Hey everyone, welcome to Making Multifamily Money. So as we kind of wait for some people to come on, I think I had two people who had some questions for me, but maybe something changed last minute. But just kind of wanted to give a preview of what the questions were. The first question was someone had a mixed use um, commercial real estate asset that they wanted me to analyze. So for those who don't know, mixed use is it's a combination where usually the bottom floor is commercial, so it's leased out to like an office building, a restaurant, a store, and then above it there's actually like apartment units above it. So this is actually very common in San Francisco, or like kind of the city areas like New York or Los Angeles, where the bottom floor is like a business, a restaurant, something that's leased out, and then above it is residential units. So overall, I'm not really a big fan of the mixed use model because to me, it's just much more simpler to just commit to. If you want to do residential, just do apartment complexes. If you want to do commercial, just do commercial, right? Where you're doing like single tenant, retail strip centers, for example, like it's anchored by a Starbucks or a 7-Eleven, or residential where it's just apartment complexes. So, to me, it's just one or the other. I think it's a lot more simpler because when you have a mixed use building, it's kind of weird. Like there's no property manager who kind of does both, right? You have a property manager who does the residential side, but you'll need another property manager to handle the leases for the business at the bottom. So in my eyes, it just doesn't really seem worth it. Unless you have such a large portfolio of mixed use buildings where you have a team and it makes sense. But for kind of the everyday average investor, I don't think it makes sense to invest in mixed use buildings. I mean, I could be wrong. I did look at it back when I was living in San Francisco. And, just like when I teach with triple net, double net, or single net leases, when you buy that type of retail strip center or single tenant property, you're basically buying the lease. Like that's what you're buying. The building itself isn't worth that much. It's the lease that you're buying and that's valuable. So to me, you just have a lot out of your control, right? Like maybe at the time you had a great tenant in there in the commercial office space. Like maybe you had a Starbucks there, for example. And then because a Starbucks is there, it's worth a lot more. But once the lease ends and maybe you have a difficulty filling that spot or you don't get as strong of a tenant, the value of what you bought goes down with the lease. So to me, I don't really like that aspect of it. And then if you combine the fact that there's also residential above it, it's just kind of this weird kind of hybrid model where it just doesn't quite make sense to me. Like once again, just commit to one. Instead of doing mixed use, like do apartments if you want to do apartments, or do office space or commercial if that's what you want to do. Don't do both. That's just kind of been my experience, but take it with a grain of salt because I haven't actually owned a mixed use building. That was just kind of my thought process and mindset when looking at the deal at the high level. Because I think from my memory, it was I think 2 office spaces at the bottom, I think 8 units at the top, and the 8 units are renting for around $1,000, and the lower office space was renting for $1,000. So in my eyes, it just so much easier to just have a 10-unit apartment complex that all rents for $1,000. So hopefully that kind of gives some context about that. Once again, I'm not a huge fan of the mixed use model. I think for financing, it's not as favorable. I think you have to do a larger down payment. Like with apartments, you can do 25% down. But with, I think, the mixed use, you're almost doing the down payment of a commercial building, which is going to be about 35 to 40%. And the loan is amortized over probably 20 to 25 years for mixed use versus 30 years for apartment complexes. So, obviously, when banks give you more favorable lending, it kind of tells you that they prefer a certain asset class, right? So there's a lot more favorable lending for apartment complexes versus commercial versus mixed use. So it's kind of telling you that the banks kind of favor residential income producing real estate, right? So the fact that you have a commercial component built in, the bank is automatically going to make you put you in the same category as commercial real estate. So the terms will not be as favorable. So that's kind of why I'm not a huge fan about it. And I think in terms of your exit strategy, I think it's a lot harder to sell mixed use building because it really requires somebody who's into mixed use buildings. Like I said, for me, I wouldn't be interested at all. I'd either want to buy an apartment or I'd want to buy a commercial office building, depending on what I want to do. So hopefully I answered that question. And the second question I got, which I want to talk about, is basically asking for financing options for apartment complex. So a lot of people have been asking me, like, well, how can I buy an apartment complex very low down? I think that's a very popular topic. And I always like to kind of preface this statement with a lot of people, when they say I want low money down, they're coming from a place of they don't have money. That's usually the situation. But I think you cannot come in with that mentality because to me, when you're doing creative financing, it requires a more skilled operator and requires someone with a track record. And, obviously you can kind of fast track your track record and your credibility by associating yourself with the right people who've done it before, right? So you could do that by bringing in a partner who knows creative financing. You can join a mentorship or a course and learn creative financing. And you can also, talk to title insurance companies. You can talk with maybe the seller knows creative financing. So I just want to preface that up front that a lot of people think creative financing because they have no money. I think it's a great place to get started, once you have the knowledge. But after that, it's not really realistic because people say, okay, I want to buy, let's say, a 20-unit apartment complex with low money down. And typical down payment is going to be 25% down, right? That's kind of on the low end, depending on how the property is doing or the interest rates, they might require a higher down payment of maybe 35 to 40% to hit that debt service coverage ratio of greater than 1.25. So if your property doesn't quite hit that debt service coverage ratio of 1.25, expect to put a larger down payment, which will lower your loan amount. So it makes it easier to hit that debt service coverage ratio. So typical low end is 25% down, right? That's your best case scenario. So why people do creative financing is they want less than 25% down. This is where you want maybe 10% down, 5% down, 0% down. Like all these deals are possible. And, while it's nice, but just because you buy a deal for, let's say, 0% down doesn't mean that you don't need any money. You still need money for like reserves, right? That you have to do some renovations. Maybe something breaks down. Maybe, tenants start to leave. Like once you take over the property, and, I experienced all this multiple times when I closed on my 2 apartment complexes as well as my mobile home park. So once again, just because when you buy low down, it doesn't mean you have no money. It just means that you can allocate your money for other things, like what I said earlier, like renovations, maybe CapEx, maybe the roof needs to be replaced, right? So just because you can get an apartment complex of 0 down and you have $0 doesn't mean you should get the deal, right? But if you get the deal of 0 down, it probably makes it easier to like partner with somebody who has money, as an example, right? So if you have that skill set to negotiate low money down, then at that point, it's very easy to pitch that deal to like a partner. So I just kind of want to preface that context first. So if you go with the traditional bank, you're going to probably do 25% down at least. If you can do creative financing, that's when you get less than 25% down. And a strategy that I kind of teach a lot of the students is, let's just say the seller wants 20% down for creative financing. Well, you can structure that in a way where I give you 5% at the close of escrow, 5% at the end of year 1, 5% end of year 2, 5% end of year 3. If that property cash flows well enough, then that cash flow will cover that 5% down for you that you owe every year. So that's kind of a creative way where you're giving them their 20% down payment. You're just spreading it out over a couple of years. So that's what I typically do. And so far, I've had no seller kind of say no to that because they're getting their money eventually. It's just spread over time, and it kind of helps reduce their tax hit as well, right? Because if you get a lump sum, you pay tax on that versus if you spread it out over 4 years, you're paying the taxes as you get the money. So it can kind of help reduce your tax burden and your tax liability a little bit. So, yeah, so that's kind of nice. And typically with creative financing, at least from my experience, if you're taking over the property subject to, so there's still a loan on the property, at that point, it basically means that it's a distressed situation typically, right? So why would someone sell subject to is because maybe they bought the house for $1 million. They got a $900,000 loan on it, but the market went down. Now the house is worth $900,000. And if they try to sell it, you take off 10% off the top. So they'll probably get $800,000. And then they have to come to the closing table of $100,000 out of pocket. And a lot of owners will not have $100,000 out of pocket to bring to the table. So to kind of fix that solution, you have to then sell that or get someone to take over the property subject to. And they have to come in with money, obviously, to execute a value add strategy to raise the property value, right? So they got it at a million, whatever. Now you can raise it up to $1.5 million after renovations, after raising the rents, after billing back water, after charging for parking, like whatever, right? Whatever you need to do to increase the income, increase the net operating income, which will increase the value. So once you do that, that's when you do a cash out refinance with a bank. You pay off the subject to agreement, and now you own the property yourself. So typically subject to is the seller is in a distressed situation. That's usually the case. So subject to is distressed seller. They usually have a loan. If it's seller financing, usually the property is owned free and clear, right? So there's no debt on the property whatsoever. So for them, they're not in pain. They want gain, right? Because they want to sell at a higher price so they get more money. They want low money down because they don't want that tax burden. And they just want interest, payments every month. So they basically become the bank. They upgrade from the landlord to the bank. So they get paid every single month automatically and free of all the management, right? Because they want to retire. Maybe they want to retire and go on vacation and travel, or maybe their kids take over the property, inherit it. Their parents passed away, and the kids want nothing to do with the management of this apartment complex, but they still want that monthly income, and the property's paid off. At that point, it's better for them to become the bank, and you just pay them, and they're free of the operations. So in that case, they're focused on gain. So once you kind of understand those two concepts, that's how you do creative financing, and that's how you can negotiate low down payments, right? And like I said, if they still want 20% down payment, 25%, ask to spread it over a couple of years, right? Worst case, 10% down at the close of escrow, they'll give you 5% the next 3 years to hit 25%, right? So you always ask to extend the time horizon if they want a higher down payment, because that's your skin in the game. And if they ask you, why do you want to put so much low money down? My response is usually, well, I'm renovating all these units. So if something happens to me and you foreclose on me, you take back over the property, you get my down payment that I put in, and you get all the renovation money that I put in renovating your apartment complexes. So that's basically my skin in the game, right? So you basically have to see what's the skin in the game, and that's my skin in the game. I put you a down payment, plus I'm renovating these units. So, it's just being able to explain most of the time to the seller in a very easy to understand way. Luckily in multifamily, the owners are typically more sophisticated and they know about creative financing. So the hard part comes down to trust. Like, do they trust you to operate this deal, right? Do they trust you? Like, do you have a track record that you can prove? Like for me, I have a track record now, right? I own 90 units of real estate. It's easy for me to say, hey, I already manage 2 apartment complexes in Oklahoma. If I were to buy another Oklahoma apartment subject to or seller finance, it's easy, right? I have a track record there. I have a property manager there. I have a general contractor there. I know what the rents are. I know what I'm doing, right? But if it's like kind of your first deal, at that point, you need to leverage a strong property manager, right? As well as maybe a team if you decide to partner, right? Like if you're part of a coaching program, you can leverage them. If you have a really strong property manager, you can say, hey, this property manager, and that's what I did starting off. This property manager has been managing apartment complexes for 20 years. And well, I might be new to the space, but my property manager has been doing it for 20 years. And you can see some of the apartment complexes that they're currently managing. If they want to vet your property manager, you can have the property manager go there, do a walkthrough of that apartment complex to see what it's like. And that's when they can meet that property manager and kind of build that trust and build that rapport, right? So that's what I do to leverage, because I'm in California and I invest in Oklahoma. So that's what I do, right? Like I'll actually send my property manager there first. They'll drive by morning, afternoon, nighttime, see if there's any, bad activity out there. Is there like a lot of gang activity? Is it a bad high crime area? There's just people kind of loitering outside for no reason. So that's what I have them do. And then, they'll look at the property first before I even, book a flight over there. So they kind of do their initial assessment. They can meet with the current owner if they want, right? To build that trust, build that rapport. And yeah, it's just building that trust. And then even when you take over the property subject to, or, seller finance, I can say, I'll show you the monthly P&Ls that I get, right? As proof that we're operating the property, because my property manager gives that to me every month. I have no problem sharing those reports with, the owner that sold this to me through creative financing. If they want to verify everything that we're doing, right? If they want to see all the renovations we're doing, if they want to see the monthly P&Ls, if they want to see how much rent we're collecting, if they want to see what our expenses are, if they want to see what the units look like after we renovated it. So it's just all about building that trust, because, people are skeptical. I get it, myself too. But once you can kind of bridge that gap and break it down, it gets easier, right? So that's kind of the name of the game of real estate. It's, build your track record, and can you get the seller to trust you if you want to do creative financing? That's it. If you can do that consistently over, 30 to 40 years, your net worth will be over 20 million easily. If you do this consistently for that long. So yeah, that's just kind of my thoughts on that topic. And I believe I had a third question. This one's kind of more specific to the Bay Area. So someone asked me, how do you recommend house hacking multifamily in the Bay Area? So I think the question was geared towards like a duplex, triplex, and a fourplex. And kind of my response was, unfortunately, with bigger pockets becoming more popular, I think the house hacking model has become more popular. So the concept is, I live in, let's say, one unit in a fourplex, and I rent out the other 3 units. And the rent from those 3 units hopefully cover all my costs. So I essentially live in my 1 unit for free. And the hope is, because it's 1 to 4 units, you can do low money down conventional loan, right? So you can do a 3.5% down FHA loan. You can do a 5% conventional loan, 10% conventional loan, 15% conventional loan. The concept is, since it's a primary residence, you can do less than 20% down. So that's the concept of house hacking, where I'll, let's say, down 5%, live in 1 unit, rent the 3 other units. They cover all my expense, do that for 1 year, and repeat that process the next year. So I'll move into another fourplex, live in that one, rent out the other 3 units, rent out the unit I used to live in, and now I should be positive cash flow. And you repeat this process every year, because you can get a new conventional loan every year, assuming your debt to income ratio is great, right? So, that's kind of the 1 through 4 units. When you're 5+ units, that's when it becomes basically commercial real estate, where it's a commercial loan, and commercial loans require, 25% down, 25% down. So it's less leveraged, and you can house hack those too, but you don't get that low down payment option. But in any case, whether you're targeting 1 to 4 units or 5 units plus, I basically use PropStream to get all my data. You can probably check the link down below. I have a referral link to PropStream, but you can actually filter out. You pick the Bay Area, for example. Let's just say you pick San Francisco or whatever city you want. You can actually filter single family home, duplex, triplex, fourplex, or you can do 5+ units, which hits all the apartment complexes. And from there, it'll give you a list of all the data. And at that point, you can, send letters to those owners. You can skip trace it and cold call them. You can cold email them. But the point is, you get this data and you're reaching out to these owners off market, because on market deals, to find a great on market duplex, triplex, fourplex, or even any great deal, it's very difficult, right? And this is not just the Bay Area, it's all across California. I'm seeing it in Southern California as well. So, because I would love, that's what I'm looking for right now in Southern California, is I want to buy like a duplex, triplex, fourplex. So I live in one side and I rent out the other side, but I haven't been successful in finding a great deal. I'd rather just rent and then go buy an apartment complex in Oklahoma for the same price, right? Like a fourplex in Southern California, it's about maybe 1.5 million. For 1.5 million, I can probably get a 30 to 50 unit apartment complex in Oklahoma. And I'd rather have that, right? Versus a fourplex in California. So if you go off market, you can find better deals. Hopefully you can, if when you work direct to the owner, it gives you more opportunities for creative financing and seller financing. So you can do low money down, create more win-win situations. And I kind of want to go on a rant about working with real estate brokers. So I'm currently working or trying to sell my mobile home park, and working with a broker. And my experience has been pretty terrible. I mean, the more people you have between you and the end seller, or you and the end buyer, it creates more points of delays. It creates a lot more, I don't know how to describe it, so much more barriers. Like something to do very simple. Like if you want to make a simple amendment to a contract, that's literally one word. Literally, I have to tell the broker, who then tells the other broker, who then tells the end buyer, and then the end buyer has to talk to their partners. So just to change one word on this contract, it takes like 1 week, 1 to 2 weeks, just to change one word on the contract. When I work directly with the owners, like I did with my 2 apartment complexes and my mobile home park, I did all these direct, no brokers involved. It literally took me like 30 minutes. I would just send the updated contract, text the owner and be like, hey, like this is the change, this is why I'm doing it. Call me if you have questions. He says no questions, signs it, sends it back. Done. Right? So if you add in 2 brokers in the mix, and they just cause so much delays, and I thought like having a broker would make my life easier. It's actually making my life harder. Right? Maybe it's not a great broker. Probably 9 out of 10 brokers are terrible. And the 1 out of 10 brokers that are great, they probably don't want to work with someone new. So that's just the name of the game, right? You're not going to attract the best brokers to work with, because 9 out of 10 are terrible, right? They take forever to respond. There's no communication. They're not proactive in anything. And that 1 out of 10 broker that's great, they don't want to work with you if you're too new. So you're kind of stuck between a rock and a hard place. So that's why for me, I said I'd rather just not deal with any brokers, go direct to seller. And maybe when I'm great enough, I'll attract that 1 out of 10 broker to come to me and actually bring me a great deal. But to this date, I've been investing in apartments for about almost 3 years now, and I've never had a broker bring me a great deal. All the deals that the brokers brought me have been bad. I've underwritten a few deals brought to me by brokers on my YouTube channel. They all been terrible, right? So I've never had a good deal brought to me by a broker. I've never had a good deal brought to me on LoopNet. So that's just the nature of the game. And that's why you have to learn how to get off-market leads, all right? Whether that's cold calling, cold mailing, working with wholesalers, even wholesalers. I never had a wholesaler bring me a good deal yet. Maybe I'm not networking strong enough, but I haven't had a good wholesaler bring me a deal either. So that's kind of my rant about working with brokers. It's just been my experience. I'm just like, these two brokers are literally getting paid $75,000 each, and they're completely useless. Like, I've never worked with someone so useless who's getting paid $75,000, and you would expect more out of somebody who's getting paid $75,000 each. And the standard is just so low that I feel like I can come in and make a better brokerage. That's how sad it is. So, anyways, that's my little side rant there about working with real estate agents and brokers. I guess any questions from, I guess, just Keenan's on. Any questions? Okay. Awesome, awesome. So I guess since we have a little bit more time here, I just kind of want to touch on a little bit about, I guess, apartment complexes. So, or just talking about the concept of scaling. So I basically scaled really fast, right? I think in 2017, I had one single family home. In 2019, I had two single family homes. In 2020, I had three single family homes. In 2021, I bought a single family home. I bought in California, I bought a single family home out of state in Alabama. I bought a 26 unit apartment complex in Oklahoma, and I bought my mobile home park in Alabama. So literally in 2021, I probably got around 60 units in about a year. And then in May of 2022, I got my 20 unit apartment complex. So literally in the span of about 8 months, I think I got around 80 units of real estate. And, it sounds impressive to say, right, on paper, but where I'm getting kind of burnt today is because I scaled so rapidly and was so focused on scaling, it basically led to a lot of issues that I couldn't anticipate, about 6 to 12 months later. And when you own 80 units that you just bought, the 6 to 12 months issues all like compound one after the other, to the point where, like, for example, my 26 unit, I had delays in getting a contractor there for 6 months. In my 20 unit, when I took over the property, I had to fumigate all 20 units for bed bugs. And because of that fumigation, when you fumigate for bed bugs, all the tenants basically have to remove everything from the kitchen cabinets, everything from the closets, and throw it in the middle and cover it. But just by doing all that work, it's just easy just to move out, right? Like, why don't they stay? And that's what they did. So a bunch of the tenants moved out, and my occupancy went from like 15 out of 20 units all the way down to like 7 out of 20, right? And that's a hard money loan, so it's due in 12 months. So, I was hit with that issue. And then with a mobile home park, same thing. Like, I had issues bringing in, for the longest time during COVID, you'd call a mobile home manufacturer to bring in a brand new home. They would say, oh, it takes 8 months from when you place an order to when you get your new mobile home. And pre-COVID, a brand new mobile home was around $35,000. During COVID, that same mobile home was close to $50,000. So it went up by $15,000. Plus, it's going to take you 8 months to get it on top of that. Right? So you have two delays. One is it takes longer to get it. And number two, it's going to be more expensive to get it. Right? And then, so like for the longest time, I got no. And then like in end of 2021, like you're talking October, September, October of 2022. At that point, the supply chain issues all resolved. And now the brokers are calling me saying, hey, we have homes. Do you want it? We can ship it in like 2 to 4 weeks. The flip completely flipped. The prices went down, right? They're not 50,000. They're maybe closer to like 40, 45. And, that kind of hit me too, right? So all these things hit me simultaneously. I had a bunch of reserves set aside. I blew through those reserves between my 3 projects. So, kind of lessons that I learned by scaling too fast is don't do 3 huge projects at the same time. If you're not doing this full time and you don't have a team and you're newer to the game. I'm newer to the game still, right? Even though I have 90 units, I'm still, relatively speaking, newer to the game compared to someone who's been doing it for 10 to 20 years, 30 years. So because I scaled so rapidly, and keep in mind, I still work my full-time W-2, right? I still work my full-time W-2. So I'm basically working 2 full-time jobs. And I was between 2 different asset classes. I had apartment complexes, I had mobile home park. So what I'm learning as I'm selling my mobile home park is, number one, just pick one asset class, commit to it, and scale around it. So I know apartments in Oklahoma very well. I can easily scale in Oklahoma and the small apartment complexes. I should have just committed to that instead of buying a mobile home park in Alabama. And I passed on a couple of deals at the same time. Like I had a 50 unit in Oklahoma that I passed on, put that money to buy my mobile home park. Right? I'm kind of punching myself a little bit. I wish I just bought that apartment instead. And then number 2 is, do not scale too rapidly. It's okay to take small steps as long as you slowly get there. Like real estate is a marathon, it's not a sprint. I was sprinting, right? I sprinted. And what happens when you sprint too fast? You might fall down, you might get burnt out. That's what happened to me, right? Versus if I just bought my 26 unit, finished it, did the full cycle burr, pull my money out, buy the 20 unit, same thing, full cycle burr, take your money out. You go buy a bigger apartment complex, same thing, full cycle burr, do your thing, money out, right? That's the logic. That may take 10 years to do that, right? It may take you 10 years to do 3 burrs, assuming each apartment complex takes 3 years to burr. That's typically the average, 2 to 3 years. But what I did was I basically bought 3 burrs within a span of 8 months of each other, and they're all going on simultaneously. And when I do finish, like when I sell my mobile home park, I'm gonna get a large lump sum. When I finish burning my 2 apartment complexes, I'm gonna get all my money back. I'm gonna be saving a lot of money, right? At that point, I can probably buy like a 50 to 100 unit apartment complex once all my money is free and consolidated. So, and that's what I'm gonna do, right? I'm probably gonna look to buy something in Oklahoma once I'm more stabilized. My 2 apartments are stabilized. I did a full burn in them, and my mobile park is sold. So I just need to double down in that. So that's just kind of a lesson that's been kind of hitting me. And it's only been hitting me because I'm feeling the stress, right? Like I'm actually a person who has a very high stress tolerance. Like I can handle quite a bit, and even me, I'm starting to get cracked down. And when you're constantly stressed and you're constantly anxious, what happens is you're not able to think as clearly and make intelligent decisions, right? Like me right now, my brain is like so overwhelmed that I'm at my mental capacity that I cannot creatively problem solve right now. I'm actually not in the right mental state to be able to buy my real estate. So it's actually great timing. I basically just need to sit back, focus on what I currently have, stabilize it. And once it's done, probably give myself a break, maybe 6 to 12 months to just relax, enjoy my profits, whatever. And at that point, I can embark again to buy my real estate, but this time just do it one at a time, right? It's just me doing it myself. I don't have a team. So my capacity is like maybe one at a time, and just doing one at a time without a team. I mean, you can get a large real estate portfolio in, the span of 30 to 40 years. I'm in my 30s, so I'm gonna be doing this for the rest of my life. So there's no rush. Just remember, it's a marathon, not a sprint. And I've seen this happen with some people as well, where they start syndicating and they went from 0 to 1,000 units in a year. Once again, sounds very impressive, but that's a huge scale, very fast. You have a lot of investors' money at risk there. So my message is it's okay to be ambitious and have big goals, but just make sure that you do it one step at a time. So that's kind of my key, is to do it one step at a time. So overall, light session today. Hopefully you found value from the session. And yeah, I guess I can open it up. Any questions, Keenan? It's just you. It's just you, brother. No questions? All right, man. Well, thank you for hopping on. This session is recorded, uploaded onto YouTube, so you can watch it again. I think it was a little bit more of me ranting today than my usual Q&A. But hopefully you guys found some value, and hopefully I see you guys next week. Have a good one, guys.